We will go through the concepts of marginal and absorption costing in this video. The key difference between marginal costing and absorption costing is the difference in treatment of fixed factory overhead costs. FRS 2 requires a company to use absorption costing. Marginal costing is not allowed for external reporting, so absorption costing is something we should be familiar with. In absorption costing, costs are classified between product and period. To recap, period cost is recognized as an expense when incurred. Product cost, on the other hand, is recognized as part of inventory. These product costs are recognized as an expense only when the inventories are sold. Here's how an income statement under absorption costing looks like. This should look familiar to you. We will take sales minus cost of sales to get the gross profit. Then we deduct period costs like selling and distribution expense, general and administrative expense, finance expense, and other operating expense before arriving at the net profit. And if you want to expand how the cost of sales is derived, it looks something like this. You will notice that direct materials, direct labor, and factory overhead, regardless of whether it is fixed or variable overhead, is included in the production cost. As long as it is a product cost, it is included as the cost of production. This is what absorption costing is about. Please also note that the under or over applied factory overhead is computed by taking the difference between the actual fixed factory overhead cost and the units produced multiplied by the fixed overhead application rate. Let's move on with marginal costing. Before I continue, please remember that marginal costing is used only for internal management because the FRS prohibits marginal costing for external reporting. Marginal cost is the additional cost the company will incur if it produces one more unit. Here's how an income statement under marginal costing will look like. We will take the sales minus variable cost, which gives us the contribution margin. Then we will minus the fixed cost to arrive at the net profit. Please note that the variable production cost is computed by multiplying the variable product cost per unit by the units sold, not the units produced. The treatment of variable production cost between marginal and absorption costing is the same. It is recognized when goods are sold. Period costs are also treated the same way between marginal and absorption costing. It is recognized when incurred. So the difference is the treatment of fixed product costs. Under marginal costing, fixed product costs are recognized when incurred. But under absorption costing, fixed product costs are recognized as part of inventory and expensed off only when the inventory is sold. To help you understand the difference between marginal and absorption costing, let me put the income statement under the two costing methods side by side. Also, I have expanded how certain figures are derived and color-coded the line items to allow you to compare the similarity and differences in treatment of the line items. Italicized line items represent a difference in treatment between the two costing methods.